Hello, this is Brendan Freeman, President of First Business Trust and Investments. I hope this message finds you healthy and you are keeping your organization moving forward despite these extremely challenging times. Even though we are working from home, today we want to share with you some perspective on your company retirement plan and some of the recent developments with the passing of the CARES Act. I'm joined today by two industry experts and members of our team at First Business, Gary Fossum and Aaron Austin. Gary and Aaron work closely with our clients in strategizing about their retirement plans and managing plans for the benefit of well over 14,000 plan participants. Both of these individuals have been following the recent changes in this space very closely, and I hope that you find the information they share valuable to your organization. The Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act, aims to help Americans cope with the unprecedented financial fallout from the coronavirus outbreak. Among its provisions, the CARES Act makes it easier to withdraw funds saved in certain tax-advantaged retirement accounts, like 401ks and traditional IRAs. These temporary changes eliminate tax penalties on certain withdrawals and relax rules on loans that you can take from certain types of accounts. Let's take a closer look at the retirement-related provisions in the CARES Act and see which of them potentially could help you cope with some of the financial stresses stemming from this crisis. Gary, can you please share some of the key provisions for retirement plans within this act?
Thank you, Brendan. So what we have on our agenda here today is to walk through a few different items and how it pertains to your retirement plan. So this is our agenda. We'll be discussing briefly what a definition of a coronavirus-related distribution actually is, what it takes to qualify for that. Then how that impacts the ability for a participant to take a withdrawal from the plan, the new loan provisions that may exist with respect to your retirement plan. And I'm going to cover those three areas. And at the end, Aaron Austin will cover the last three items that you see listed. The new rules with respect to required minimum distributions, how we go about plan amendments, and then lastly, just some expanded authority by the Department of Labor. So if we look now at what is the definition of a coronavirus-related distribution, really there's three things that a participant would have occurring in their life. Number one is that they would have been diagnosed with the COVID-19 virus. Number two, a member of their family or their spouse would have been diagnosed with the virus. Or the third one is that the participant has suffered adverse financial consequences. So that's things like I've been quarantined, I'm furloughed from my job, I've been laid off, my hours have been reduced due to the virus implications. Perhaps I'm not able to work because I've got to be home for childcare. Those are also things that qualify for us. Reduced hours. So if I have one of these three events, I qualify for what's called a COVID-19 distribution. So the one thing that we'd like to point out with respect to a COVID-19 distribution is that it is the participant that has to certify that one of these events has occurred in their life. The burden of this is not on the plan sponsor to prove, document that your participant has a COVID-19 distribution. So if we look now at what that does with the impact on plan withdrawals, you'll see that under the new rules that a participant can take a distribution from their retirement plan if they've incurred a COVID-19 event. Your plan presently may have in-service distribution provisions. It may have hardship withdrawal provisions, but this is different. This is above and beyond those particular provisions. Your plan may presently say that you can only take an in-service distribution of rollovers, or it may only say that you could take an in-service distribution of employee dollars. This is different. It would allow a participant to take a distribution of up to $100,000 of their account balance, and that distribution is not subject to the early 10% distribution penalty. Additionally to this provision, the participant is able to spread the tax ramifications on this over 3 years. So I'm still going to pay federal income taxes on it if it's pre-tax dollars that I'm taking out of the plan. But the IRS is going to allow us 3 years to be able to pay that tax. There needs to be some further clarification from the Internal Revenue Service as to exactly how that's going to work. But it is a 3-year payback that a participant could elect to pay the tax on the distribution. The other thing about it is the participant is going to be allowed 3 years to be able to roll that money back into the plan. So if I took a distribution in 2020, I really have 3 years from that date to be able to get the money back into an IRA, back into a 401k plan, and be able to avoid the taxation on it. That will probably take me having to amend my tax return if I go that route. I mean, and all those things as well will be worked out as we go further down the road. These are substantial distribution options that are now given to a participant, and this one is in place from January 1st until December 31st. Now, if we look at the loan provision of the plan and kind of just discuss that for a second, in essence, what has happened here is they have changed the collateral requirements that exist within retirement plan loans. Under present law, I'm limited to 50% of my vested account balance to a $50,000 maximum loan. Under the CARES Act, I'm able to take a loan for up to $100,000 and 100% of my vested account balance up to a maximum of $100,000. This provision is in place for 180 days, meaning that from March 27th to September 27th, that's when I can be able to take one of these loans. And again, I need to have a COVID-19 qualifying event to be able to take this loan provision. One of the things that's important on this one is a plan sponsor may already have a loan policy, and this may require some discussions with the plan sponsor as far as need to amend your existing loan policy. As an example, if my loan policy presently says that I have one loan outstanding, even though I may have a COVID-19 event, and if I already have a loan, you'll need to have a discussion about amending your loan policy so that you could allow an additional loan for a participant that may be impacted by a COVID-19 event. One additional provision that exists with respect to plan loans is that it allows for a deferment of current loan payments if I have a COVID-19 event. So a participant can defer their loan payments from March 27th to December 31st up to 1 year. Interest will continue to accrue on that loan. And then what will happen is we'll be re-amortizing those loans as we get into the first of 2021. And it does allow the participant to extend the maturity of the loan by 1 year from the original maturity date. The important thing to point out about the entire CARES Act is these provisions are optional for plan sponsors, meaning that as a plan sponsor, you don't need to adopt these if you do not wish to do so. Some firms within the record-keeping world are taking the position that the plan sponsor automatically adopts them, and then you have to opt out of that. We've taken the position that we want you to opt into it and decide as a firm whether you want to be able to offer these kind of types of provisions to your participants. Now I'm going to turn it to Aaron, and Aaron's going to talk about the required minimum distributions as well as the Department of Labor and a couple of other items.
Thanks, Gary. So as far as required minimum distributions or RMDs, for 2020, they're waived for all types of defined contribution plans. That includes 401ks, 403bs, and governmental 457bs and IRAs. The other thing that's important to point out here is that RMDs used to start at age 70.5. Now they start at age 72. So this is a true waiver. The client does not need to make up this distribution for next year. Currently, there is no language in the bill that says if someone already took an RMD that they can put the money back in. The exception to that would be if they've taken their money out within the last 60 days, they are able to roll the money back in. However, the last time there was any type of RMD relief was back in 2009. The IRS did allow RMDs to be rolled back in. We would make the argument now that there is a case for relief stronger now than there was in 2009. So this is also just something to kind of keep an eye on if you already have taken on RMD and you are past that 60-day window, that hopefully the IRS will allow you to roll the money back into it. So individuals that are eligible for Corona distribution who receive such a distribution in 2020 can roll it back in, and keep in mind that dollar amount changed to $100,000. For plan amendments, the plan amendment deadline for adopting any of the relief provided under the proposal would be no earlier than the last day of the first plan year beginning on or after January 1st of 2022. So keep in mind this is pertaining to calendar year plans. If you don't have a calendar year end plan, please reach out to our team and we'll direct you to what that date would be. So there was an expansion of the DL authority that was granted to waive any ERISA opposed deadlines for up to 1 year. This could impact salary deferral contribution deadlines, participant notices, 5,500 filing deadlines. But keep in mind that the DOL must take action in order for this to have an impact. So currently, the language is in there that it's granted authority to waive any ERISA imposed deadlines. But if anything takes place or anything is changing, we'll definitely be reaching out to our clients. If anyone has any questions about this, please let us know. And I'll flip it back over to Brendan.
Well, thank you, Aaron, and thank you, Gary. That was extremely valuable. At First Business, we strive to provide you information just like this that will help you to make better decisions for your company or for your organization. For additional resources, we would encourage you to visit our website for more information about this topic and many other topics related to your retirement plan or your business. I would also invite you to reach out to our teammates, many of which are listed here, for more information about your specific situation. We appreciate your time today, and we stand at the ready to serve you during this time. Thank you, and please stay healthy and stay safe.